we're going to analyze the economic position of Meta platforms. That's the parent company of Facebook. They have also Instagram, WhatsApp, Threads, etc. So yeah, basically every one of you should now know what company we're talking about. And we're going to use the cash flow statement. And through that, we're going to take a bit of a deep dive in the latest 12 months of economics in Meta platforms cash flow. And through that, we can get some truths out, and hopefully that can help you as an investor to see if this popular company is something that you feel like you might be interested in investing. And if you're not, hopefully you can learn something from the video here about the cash flow statement and how you can use it to your own benefit when you invest, because investing gets a lot more fun if you take a deep dive before you invest in something and you feel secure about your investments, rather than just going with the markets and investing based on someone else investing. So why I've chosen Meta Platforms for this dive here is because the company has performed really good on the stock market, even or since basically 2020, when they hit the bottom there during the pandemic. After that, they have had a steady rise, and it has been a really good performing stock in my portfolio and also for many fund managers, etc. So yeah, it will be interesting here. So hopefully you will follow me on this deep dive. Okay, so here we have the cash flow statement of Meta platforms. I use Seeking Alpha here, and without even creating an account, I can get this information. So it's very available for all of you, which is why I'm using it as an example. Obviously, you can use some of the large language models like ChatGPT, etc., to do your due diligence also, but you have to compare that with other statements. I'm also going to use this term TTM. That means trailing 12 months. So it's the latest 12 months from March 2025 to March 2024. So that is the period here we're going to analyze. And I'm doing that to have up-to-date information because it's not as interesting to analyze what happened back in 2020. If we start with the net income, we can see that from 2020 to today, we have more than a double in net income, up to $66.6 billion. And this is also why the stock has increased so much over time. One of the reasons. So they have really performed in terms of net income really, really good. And yeah, net income might be the first metric we can use. Looking at the cash flow chart here when analyzing the stock, because through that we can use the market value of the company, and we can have the price through the earnings, and we can get a price per earnings, and that is a very useful metric when you analyze a company. And you can see, if you have a chart over like 5 to 10 years, you can see if the price per earnings at the moment is a lot higher. And if the price per earnings is a lot higher and the growth rates are slower than historically, the stock might be a bit high, and you should be careful when you invest. Anyway, we use this method of calculating the cash flow here when we start with the net income, and after that we subtract cash flow through the we subtract some things from the operating activities to get the cash flow. So first we have the depreciation and amortizations here. So sometimes you do some big investments, and that will affect the net income in a certain way. And maybe you pay it upfront, so you use cash, and you use more cash at the moment than what will affect the net income at the moment. And therefore you have to increase the level of cash here to operating activities, at least if you are Meta platforms. So we increase the cash through depreciation and amortizations here with 15.8 billion, and also adding some goodwill and intangibles. So it's 16 billion added from the net income. So we increase the cash flow. After that, we have some more things from the operating activities that we have to account for. Here we have an interesting something interesting called stock-based compensation. So this is something that we account for in the net income. That is the rules of general accepted accounting principles. But stock-based compensations, the effect of it on the net income is bigger than the effect on it on the cash. So I have to reallocate some cash here to the cash flow statement to show the true amount of cash balance for the company. So therefore, we, despite the stock-based compensation decreasing the net income, it's now we have to bring that stock-based compensation back here to increase the cash flow with $17.2 billion. Here, when we have inside like this, that means that we are removing money from the cash. So this is some other operating activities. You can see here, including some generating revenue, paying expenses, and funding working capital. So here we subtract some cash from the cash flow statement that has not been accounted for in the net income. And same with some changes in the account receivables. So basically, this is some cash that has been accounted for as more positive in the net income. And the last post in the operating income is some other changes. I don't want to take you too deep here on the cash from operations. So the big things here for Meta we can see is that they have a lot of depreciation and amortizations. So they have done a lot of investments that they have to pay off. And through accounting principles, if you, for example, buy a large plant, maybe you write that cost off during 5 years. So it will affect the net income in 1/5 of the total value every year, but maybe the cash flow is affected by the whole value at the specific moment. So that can be one example of how it works. And this time they have paid. They haven't accounted for some of the cash, so the net income is increasing by that amount. Here we have some cash flow from investing activities. So this is quite a simple one. Capital expenditures. So if you invest a lot of money in as I said, in plants, in other big expenditure, CAPEX, that is not accounted for in the net income, but it's still costing a lot of money for the company. So you have to adjust for that in the cash flow statement. And also, you should know that the cash from operations and subtract the capital expenditure. If you do that, you have the free cash flow, a very useful metric when analyzing a company. So that is something some of you probably have heard about. We also have some investments in marketable and equity security here that are costing us cash upfront, but do not affect the net income. And the cash from investing here as you see, is $58.4 billion. So despite having this huge 96.1 billion in cash from operations, a lot bigger than the net income, because we added cash from the depreciation and amortization and also from stock-based compensation, we are subtracting a lot of cash here. And this might feel like, oh, that's enough, but actually it's not. As you see, compared to back in the days, the cash from operations has really increased, and so has also the cash from investing. And if you follow the earnings call with the Meta platforms, and you hear Mark Zuckerberg talk, you can tell that they have a lot of questions for him about the investments and the capex, because the numbers here do not lie. They are using a massive amount of cash at the moment, for example, for their reality labs, increasing their presence in AI, etc. So you need to use when you invest in a company, you have to use obviously the different big statements like the income statement, the balance sheet, and the cash flow statement, and also listen to the earnings call so you can make the puzzle. Because sure, capital expenditure, we can see that they are investing a lot here, but what is behind the numbers? You can get a clue about that if you listen to the earnings call, etc. Then, so when if you're gonna have a full cash flow statement and know how much cash you have left, you need to start with the cash from operations, and you start with the net income, and then you adjust for cash flow from operating activities. And after you have adjusted, you have cash from operations, and then you use the cash flow from investing activities. And after that, you also have to adjust for cash from financing activities. And when you have done that, you have, like, on the bottom line, true cash. And the cash is very important for a company, because especially for a lot of smaller companies, it's not the net income problems that arise from that will cause them to go bankrupt. It is that they don't have enough cash to pay their bills at a specific moment. And that was also the problem for Tesla some years back. So the cash flow and the free cash flow, etc., is really important metrics for companies, and a lot of investors actually use a discounted free cash flow model when they invest in companies, because they feel like that tells them more about the efficiency of the company and the potential for the company to provide cash for dividends, share buybacks, etc. And that is why a lot of analysts are using the cash flow when they do investments. And therefore, I also want you guys to understand that this statement is very important, and through real examples, we can use it and become better investors. And that is what this channel is all about. So in financial activities, we have some different areas here which are interesting. So we have one line here. We have issued some debt that has increased our cash position, but we also decreased our cash by repaying some debt, which is a nice expense sometimes if you need to decrease the debt you have. Here we might have one of the most interesting aspects of the cash flow statement of Meta platforms. The repurchase of common stock is $43.3 billion, and that is such a big amount. That just tells you that the amount of cash this company has is insane. It also tells us that they put a lot of upward pressure on the stock price. They are decreasing the amount of outstanding common stock. So basically, the stock you have left will go up in value. It can be a sign of weakness sometimes if the money they use to repurchase common stock, if they used it in some areas that would spur growth, maybe buying another company or investing in some specific areas. Um, it could have been used better. Who knows? It's actually quite hard to know because we have a lot of information, but we do not have all the information. All information we need, like if you have, for example, your personal bank account, you have all the transactions you have done during the month, every single expense. Oh, they pay this amount for a specific car, this amount for toilet paper, this kind of rent, this kind of uh, you know interest payments, etc. So we don't have that much information. We have a lot of information, but not everything. So here we have to have like bigger strokes when we do our investment thesis. And we need to search for different kind of clues and have a long-term mindset, because we don't have enough information to have a short-term mindset. Someone has, and that person has an edge on us and an investor if we don't have that information. But we can use our long-term perspective to see where the company are heading based on what they are doing here. So that is important. So we can see they have a lot of cash that they have used here to decrease the cash they have. Sometimes you have to, if you have a lot of stock-based compensation, Meta Platforms, as we did see earlier, had over $70 billion. That's like, as a percentage of market value, that's the highest of the big companies in the world. So they really are trying to get a lot of talent and use stock-based compensation to bring that talent into Meta platforms. That's obviously one of their ideas here, I can tell. And maybe you've heard on the news they are accelerating this to the reality lab and AI investments, and trying to pick the best brains out there to improve. They are taking them from startups, from Apple, from OpenAI, etc. So we will see if it works. And here you have the real numbers that they are both issuing a lot of stock-based compensation and also repurchase a lot of common stock. So it can be a sign of very smart use of money and decreasing taxes, but it can also be a sign of them trying to run really, really fast here, and hopefully they are not paying too much of the, what can I say, the value that we investors are putting in them in terms of buying and holding their stock, the trust we have in them. Hopefully, this is not a way of breaching that trust. Let's hope the strategic outlook here from Zuckerberg and company is good. So here we have dividends. That's also cash out. If you compare to net income, dividends do not count in the net income. Not everything here is adjustment from the net income. So it's dividend do not count when we speak about net income, but it counts here in the cash. Therefore, it's really important just not to look at the net income. You need to look at both the balance sheet to know how big the debts are in a company long term. You need to look at the income statement and how you reach that net income, because it can be short-term gains that provide you with an amazing result in net income, but you also can't reach a full conclusion if you should invest in a company just through the income statement and the net income. You also need to adjust for the things that do not fit in the net income, like, for example, dividend payments, because you need to see if the company really can afford to pay out the dividends they have after adjusting the net income and reach this point in the cash flow statement. So here we have the cash from financing is very, very high. We have to decrease the cash with $40.5 billion. So it's staggering amount that we're talking about. And yeah, some adjustment for foreign exchange rates. They always talk about these type of rates when you listen to earnings call, because it's global companies, etc., not just companies doing business in USA. And in the end of the day, this means that the net change in cash is minus the latest 12 months for Meta Platforms, $3.2 billion. And they have obviously a lot of cash on hands. That's why you need to go to the balance sheet also to see how much cash do they have on hands. Is this something they can afford, or do they have to issue more debt through diluting shares, etc., but they don't. Likewise, we can analyze from 2020 here and today how the numbers has been for them. So they have a lot of small negative change in net change in cash, but during 2023 it was 27.2 billion dollars plus. So they really can afford this 3.2 billion dollars in net change in cash to the negative. But that also means that they are burning a lot of money at the moment. And as an investor, we should ask them the critical questions about what they are burning money on, why they are burning, and if we have any ROE, return on equity, and ROI, return on investments in the company. And when I listened to the latest earnings call and the questions from the analysts, do we call them that? The big banks that have persons out there asking questions to the CEO. A lot of questions is about the big capex at the moment, the investments in AI, in infrastructure, in AI chips, etc. Are we really going to get that return on investments for the company, or are we just burning a lot of money at the moment? I remember a couple of years ago for Meta platforms. They were called Facebook at that moment. I think it was 2022 or something. The stock was not doing too good because they started to invest a hefty amount of money in the Meta Quest sets, etc. This is why they changed the name to Meta, Metaverse, etc. And investors just felt like it was too much cash spent on things that would not give them back enough money in return. So hopefully this time that will not spur some negative effects from Wall Street. I think it's quite easy to see the return on investments in terms of AI and how you use AI to get more, money from advertising, because AI can see the patterns that fits really good with what Meta platforms are really earning their money from, which is advertising. So I can feel like probably I can see the investments here being not that risky in comparison with what they did when they just build a lot of like infrastructure for the metaverse, etc. That is more of a long shot, long term, that will not see the benefits short term. But obviously, the longer they wait, the cheaper great graphic cards, chips, and computer chips, etc., will be. So it's about the timing here for the big tech companies and how they manage the situation. So yeah, that is basically what I wanted to talk to you about today. How we can analyze a cash flow statement, how we can use it to gain knowledge of a company, just not investing in companies without actually reading the available information. This is not even behind a paywall, it's available for everyone. Because it's available for everyone, you can also search for it in like ChatGPT easily, because ChatGPT just read from every available source out there. So if you ask ChatGPT the correct questions, you can ask about how all of this is working. So that's really amazing. So I just feel it's very fascinating how we can go from 66 billion in net income, and then someone tell you, oh, but they have like just they are losing cash, $3.2 billion. They are the worst company. What's going on? And then you obviously, because you know these things now, can tell them, oh, but if you adjust for operating activities, you actually have a cash from operations that is $96 billion, not just $66.6 billion in the net income. And through that, they can actually afford these type of expenses and capex without diluting the shares. And they also did a lot of share buybacks that are actually strengthening our investing thesis and pushing the stock price up. And this is what I'm searching for here in a company. Just having a company with the strength in cash flow from operations, so they can really push the stock long term to a place where I want to be. For example, that could be an investing thesis. Anyway, don't forget to always do your due diligence. I'm just obviously I work in economics as a controller, but I'm not licensed as an advisory. And if I was, you still have to do your own due diligence because economic advisories are not allowed to freely give advice and push you to do something. Just remember, you always have to do your due diligence and take responsibility for the investments you do, and you can't blame any friend, anyone on YouTube. You just have to gain the knowledge you need and complement it by reading more. And hopefully, long term, this information can be useful for you. And I'm really glad that you tuned in today. And thank you so much for watching.